Yeah, I mean, the Fed has been the story, I think, for the last 6 months. I mean, obviously, too tight was the perception in the fourth quarter. And then, of course, they pivoted aggressively. Our economist, Ellen Zentner, just took out her hike for this year. So we have no hikes now predicted for 2018, or 19 rather. And we think they could come back to the market next year if things strengthen again. We'll have to wait and see if that happens. So we've had the revaluation. We had the devaluation, the derating last year that we expected, and we've had a full re-rating already this year. Just in round terms, we've gone from about 13.5 times earnings at the lows in December to something like 16.7 times forward today. Now, that doesn't seem egregious, but that's about as full as we can get, given that we think earnings forecasts still have to come down by about 5% for the next 12 months. And so it's just going to be hard to grind higher at the index level. But I think the market is now looking at idiosyncratic factors and trying to find value in the market, which is what today is about, a rotation back to the cyclicals because of the China data, because of the PMI data, which you mentioned. And that's where the value is. The value is no longer in the growth names. It's no longer in the defensive names. It's now in these cyclicals and these early cycle groups.
Mike, I feel like we should just set up your calls for a little bit. So you turned pretty cautious last year when we went into a pretty steep downturn in fourth quarter. And a lot of people started following you. If I'm not mistaken, I mean, I feel like you've been cautious ever since, and you haven't really been a buyer into this amazing rally that we've had in the first quarter. So where does that leave us?
Yeah, so our call at the beginning of the year was that we called for a rolling bottom. We thought the weakest links would rally first. So things like EM and these early cyclical stocks, because we felt like those had priced in the slowdown that we were looking. So we actually did upgrade EM at late last year in November. We looked at some of these early cycle groups like semiconductors and home builders and banks and energy. And then the market morphed again into the growth areas. And that's when we got more cautious again, saying we thought the market was getting too expensive, particularly some of these growth areas. And yeah, we were too early in that. The market has continued about 100 to 150 points higher than what we would have thought. We thought 2750 would have capped us, and we've been wrong on that. But that doesn't mean that we should be chasing the expensive parts of the market. We think that what's going on today is reflective of what we think is going to be going on going forward, which is the market needs to have value to come in, and these are the groups that they should be buying. You should be looking at these early cyclical groups.
Like what? Go into some more specifics for us.
So like EM, some of the financials, which have really been beaten up here recently, materials, some of the industrial areas, and then the more cyclical parts of technology as opposed to the late cycle groups like software. So today our note was about software specifically, once again, talking about how that's where there was a margin disappointments all through the fourth quarter, and software was one area where we saw very broad margin disappointment, and yet expectations are actually going up for margins to be okay. At the same time, multiples are quite high. So we think what's going on is people believe we're in a late cycle environment, and they're willing to pay up for defensiveness. And I would characterize software as being sort of a defensive group. And we just think that type of stuff is getting too expensive, much like the bond proxies got pretty expensive as obviously yields have come in here over the last month or so.